Now, even though the JP Morgan Equity Premier Income ETF Jeppy is not necessarily the best high income ETF across the market anymore these days, in my opinion, I'll probably always have somewhat of a soft spot for Jeppy. I mean, I still own hundreds of shares of it in my long-term portfolio as of right now. And honestly, this ETF is one of the first ETFs a while back that got me into the idea of investing into an ETF that offers a lot more income generation from day one. Because you see, even though these days there's tons of different high income ETFs across the market that might offer a 150%, 120%, 80% distribution rate, back in my day when I first started dividend investing, there were much less high income ETFs to choose from, which definitely made Jeppy seem like an amazing pick back in the day. But in this video specifically, I want to go over a different ETF that a lot of investors seem to be selling Jeppy for and moving into. I'm going to talk about all the pros and cons about moving from Jeppy into this new ETF and share with you why exactly lots of investors are choosing to do so. All I have to say is if you like Jeppy, you are definitely going to want to stick around and learn more about this one. My A to Z dividend investing ebook has already helped countless dividend investors get started with their journey. And my custom dividend tracker, the one I use all the time on my videos, has also helped so many investors stay organized and has actually helped them see their dividend income grow. Well, today I have something even better for you guys. When you click the first link down below in my description and you grab my A to Z dividend investing ebook, today you're not only going to get the ebook, but you're also going to be getting the custom dividend tracker, which you can use to track your own dividend income ongoingly. Get direct access to my personal email where you guys can email me any questions regarding dividend investing. You're also going to receive a link to view all of my holdings inside my 7-figure dividend portfolio and see all the positions I add and take away ongoingly. And you're going to get for absolutely free my brand new high yield dividend investing ebook where I show you the power of maximizing some of these high yielding ETFs and teach you everything there is to know about that also. This is going to be your one shot to grab everything inside of one single bundle, but you got to move quick because I'm not going to offer this for long. Now with all that, let's get back into the video. So this article from Jack Bowman on seekingalpha.com, it says, sorry Jeppy, GPIX is my new covered call ETF of choice. I started reading through it a little bit. It was a great breakdown, a great collection of reasons on why GPIX is honestly the better pick, which I also agree with. So let's read on. The summary says JP Morgan Equity Premier Income ETF Jeppy has underperformed expectations as growth stocks outpace value, widening the gap this year. Jeppy successfully avoided significant downside volatility with a similar drawdown compared to broader S&P 500 funds like GPIX during market declines. However, in bull markets, capturing upside volatility is critical, and GPIX demonstrated stronger performance by participating more fully in market rebounds. I see more upside for mega-cap growth stocks ahead of us, and so I expect GPIX to outperform Jeppy. GPIX also outperforms on a tax-adjusted basis due to its favorable ROC tax treatment, which I love, and comes with more stable, but sometimes even smaller dividends. So first it says the Jeppy bet did avoid downside volatility. This is a direct folio of my change. The Jeppy would be a better choice for volatility ahead. To be fair, Jeppy suffered far less in the Liberation Day fallout, with less than a 10% drawdown from the start of the year against GPIX's 14% drawdown. Looking at top to bottom from February 19th to April 8th, the full crash Jeppy outperformed as expected, and GPIX suffered basically the full drawdown along with S&P. My pick for volatility avoidance with cover call funds K and G, which I build as a safer than Jeppy, did perform well during this time also. It then says GPIX carried much more upside volatility. We must remember that in a bull market, capturing upside volatility is an important task. It's not always about drawdown protection, it's also about how fast can the fund or the stock recover. Let's look at Jeppy and GPIX attain their respective exposures. Jeppy owns a curated basket of stocks decided on its own by a portfolio manager. The mix is designed to provide a higher natural dividend than the S&P 500, but also to represent more value-oriented take on large cap US stocks. It holds far fewer than 500 stocks, around 125 as of right now, and has a very strict weight caps on its portfolio, which are not weighted by market cap. Then it sells covered calls in a roundabout way. More on that later though. Against the S&P 500, effectively it is long an actively managed basket of stocks and short the index. Now GPIX on the other hand is long and short the S&P in both ways. This makes it a much more straightforward bet against volatility as opposed to introducing factors like value and quality to the mix. While technology is Jeppy's largest exposure, its level is far lower than the market weight, and is what caused the skew of returns between Jeppy and the market cap weight of the S&P 500. Now compare this to GPIX's allocations, which are the S&P 500 instead of an actively managed list of stocks. This leans far more into tech, the growth factor, and holds some stocks at very high allocations, like its 8% allotment in Nvidia, around 7% of Microsoft, and Apple. Since these are the firms that have been most rewarded by the market as of late, it makes sense that GPIX has outperformed Jeppy. It's heavier on the stocks that have dominated the market. Next, very important to a lot of us dividend investors, Jeppy versus GPIX dividends. Of course, while my decision to exit Jeppy is mostly about where I think the price will go, we do need to discuss dividends. The whole point of owning either of these funds is to produce income. Now, over the last year, Jeppy has produced more income than GPIX, especially during the April crash, although both are in the same ballpark. One thing to note is that GPIX tends to have less volatile distribution amounts, which I personally like. I like to have an idea of how much I'm going to earn every single month. This is reflected in their distribution yields as well, which both hover around 8%, although GPIX ran up to 10% during the April lows. When we're talking taxes on these distributions, as the mechanics that both funds use to create income are different and result in different tax implications. Jeppy uses equity-linked notes, or ELNs, which are effectively in-house swaps that synthetically provide exposure to the S&P 500 covered call. As options in price, but not in tax treatment, distributions made by Jeppy are largely considered ordinary income. In contrast, GPIX options qualify as favorable tax treatment by the IRS and are distributed as a return of capital. Now, ROC is much more favorable because it allows you to basically lower the cost basis on your holdings. We talked about this before. So in conclusion, they said ultimately it was tough to make the decision to exit Jeppy fully, but I believe that the prospects of higher returns are currently better with GPIX and have been slowly moving new money buys into GPIX over Jeppy since June. It's taken a while for me to come around to an idea of fully exiting until now. Now, I've said this time and time again about GPIX, the Goldman Sachs S&P 500 premium income ETF. For those of you guys that own Jeppy, this ETF is definitely worth looking into in my opinion. The ETF offers S&P 500 exposures. They dynamically sell calls, which means there is going to be much more participation in market rallies. And specifically for me, someone that wants to have an idea on how much income I'm receiving every single month, the distributions are very, very consistent. Now, even though I've yet to decide if I'm going to fully sell out of Jeppy, I have sold some of my shares of Jeppy for GPIX and SPYI and others. There does seem to be a good argument to move this position over to a different high income ETF that offers more favorable attributes like we just talked about. So now that we talked about Jeppy and GPIX, and we talked about how Jeppy could just be a thing of the past moving forward, I want to hear from you guys down below. When it comes to high income investing, if I were to ask you to pick between Jeppy or GPIX, which would you personally pick? Let us know in the comments down below. If you enjoyed this video, make sure to please drop a like on it, subscribe, and I'll see you in the next one. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.